Today I'm going to be speaking on two costs, which is marginal cost and absorption cost. So let us start by understanding what is marginal cost. So the definition goes like this: marginal cost, or rather the formula, marginal cost is equal to direct material plus direct labor plus direct expense plus variable overheads. So what marginal cost does basically is it basically takes only the variable cost into consideration and it does not consider the fixed cost. So now we look at this diagram. Direct material, direct labor, factory overheads, all the variable costs, they are charged to the cost of production, and that in turn is charged as an expense when goods are sold. So what does this mean? This basically means that all of these variable costs are taken and charged to the cost. So what forms today? When you look at pricing as a whole, today you need to consider three things. That is your sales, your selling price, your profit, and your cost. So this your variable costs are basically charged to the cost factor in that formula, and that in turn helps you determine your selling price, which will help give you the profit margin that you're looking for. So now what are the advantages of marginal costing? So the first thing is that it's constant in nature. So what it states is that variable costs fluctuate from time to time, but in the long run marginal costs are stable. So as we learned in our 11th and 12th standard, what happens is in the short run you have fixed costs, you have variable costs, but in the long run all the costs become variable, because what happens is, say you purchase a machine, for example, there has a limited life, and you charge depreciation over a period of time, and at the end of say 5 years, 6 years, whatever is the predetermined life of the asset, it is going to be discarded and a new asset is going to be acquired. So what happens here is, the reason why this says that in marginal costing, the advantage is, what it says is that variable costs fluctuate from time to time, but in the long run marginal costs are stable. So what happens is, in the long run all the variable and fixed costs become variable, and that helps bring a sense of or a feature of it being constant. Now marginal costs remain the same irrespective of the volume of production. So as you know that your when you're computing your direct materials, labor expenses, all of that, what would differ is only your volumes, but at the end of the day your cost remains the same. And so what it says is that in the long run also the marginal costs remain the same. Now when you look at the second point, that is effective cost of control, it divides cost into fixed and variable. Fixed cost is excluded from the product. As such, management can control marginal cost effectively. So what this states is that in marginal cost, you're considering only the variable cost in your cost of production, and as a result of that, what happens is that is excluded from the price of your product. So only you have a variable, you have fixed. So only the variable component is included in the cost of your product. Now, as a result of this, management can control the marginal cost effectively, because what happens is, now that you've separated the fixed cost, management can focus on variable cost and see what is it that they can change or what improvement they can make in order to control their costs. Now, the third point is uniform and realistic valuation. So as the fixed overhead costs are excluded from the product cost, the valuation of work in progress and finished goods becomes more realistic. So now, as you know that your cost of production is forms a large component of your inventories. So in your inventories, you have your capital work in progress, you have your finished goods, you have your your stock in trade, all of that. Now what happens here is that as the fixed costs are excluded, your from the product cost, the valuation of work in progress finished goods becomes more realistic. So what happens is, now that you have removed your fixed costs, your inventory your inventory cost consists of only the variable cost, and that makes it more realistic, because what happens is, that is variable costs are the things that you incur in the short run more frequently as compared to your fixed costs. Now fourth point is helpful to management. So it helps the management determine which line of production is profitable and which isn't. So see, now what happens is, now that you've excluded your fixed cost entirely, it helps the management determine, in large factories you have different lines of production. So that helps the management determine which line of production is performing, which isn't. And you may probably be asking the question, why isn't fixed cost computed over here? So what happens is, see, in a factory, when you're starting a factory, you're using a fixed cost to acquire machinery, and that machinery, it could be the case that one machine is used to produce multiple different goods or different categories of goods. And so what happens, your line of production is different, but your fixed asset is the same. So as a result of that, it helps the management exclude the fixed cost of the fixed asset and consider only the variable cost, which is basically is different for different lines of production. Now, disadvantages. So the time element is ignored. So fixed costs and variable costs are different in the short run, but in the long run, all costs are variable. So as I mentioned earlier, and in the long run, all costs change at varying levels of operation. So see what happens is over here, in the short run, your variable costs and yeah, your fixed and variable costs are different in the short run, but in the long run, all are the same. So what happens here is in the long run, all the costs change at different levels of operation. So your machinery will be replaced, or some other asset, maybe a car or something, will be replaced. So all of these things become variables at the end of the day. Now the significance loss. So in capital intensive industries, that is capital intensive industries are basically industries where you have a large amount of capital in the form of machinery and all of these things that are being invested. So you have two types. You have capital intensive, you have labor intensive. So labor intensive are, where you have a lot of human resource, and capital intensive where you have a lot of machinery. So now in industries where there's a lot of machinery, you have fixed costs occupy major portions in the total cost, right? Because see, you hardly have labor and stuff. You have more of your money invested in machines, and so what happens is that forms a large part of the product, and but your marginal cost covers only the variable cost, and as such, it loses its significance in the capital industry. So in the capital industries, you have a lot of issues because variable cost is present in your pricing, but your fixed cost is not present. But in reality, that forms the majority of your costing. Now, claims for loss of stock. So now, insurance claims for loss or damage of stock on the basis of such a valuation will be unfavorable to the business. Now, what happens here? Let me explain. So when you have some uncertain event that has occurred and you're incurring a loss as a result of that, you need to claim for insurance, of course. And what happens there is, since you're not considering fixed cost in your pricing, your total cost of the product reduces. And so when you're claiming for insurance, you cannot claim for the high amount. You can only claim for what your variable cost stands for. But if you were to include your fixed cost, the cost of damage would be higher, and that would give you a chance to claim for more insurance. But that isn't the case for marginal costing. So that is another disadvantage. Now we have this diagram. I'll just go through it. So you have characteristics of marginal costing. So the first is classification into fixed and variable. So as I mentioned, marginal costing is classified in the sense that fixed cost is not included in the total cost. So it is divided and only variable cost is considered. Now the next is valuation of stock. As I mentioned, your inventory valuation differs. Then you have profitability and determination of price. So now profitability, what happens is, see, if you're not including a fixed cost in your product, naturally your cost of production is going to be lower, and that is going to increase your profitability. But now when you talk about determination of price, so as I mentioned again, when you have a selling price is equal to your cost plus profit. So now if your cost is, say you're targeting a certain fixed rate of profit, right? So if profit is constant, and if you're looking at a certain selling price, the only thing that is shifting in the formula is the cost of production. So now what happens is, the cost of production, as it varies, your selling price will also vary because your profit remains constant, right? So what happens is, over here, that change in cost of production will help you determine the price at which the price that you have to set in order to earn that fixed amount of profit. So now the second type is absorption costing. Now when we see what absorption costing is, it is simply, simply, I wouldn't call it the opposite, but what you could say is it includes fixed cost. So now marginal costing does not include fixed cost, but your absorption costing, it includes fixed cost. So all manufacturing costs, both variable and fixed, are allocated to the product. Now stocks are valued at their total manufacturing cost. So when you talk about total manufacturing costs, as you can see in the diagram, variable and fixed costs are charged to the cost of production. Now the next thing is advantages. So when you look at, the first thing is gap compliance. So first let me explain to you what is gap. So gap is simply your general accepted accounting principles. Now this is as per the United States framework. Now what happens is you have two things. You have US gap and you have IFRS, which is your International Financial Reporting Standards. And that is basically, long story short, IFRS is followed by all the countries in the world. It's a common framework or common standards that are set for financial reporting. Whereas over here, you have US GAAP, which is only followed by the American companies. So now one of the main advantages of choosing to use absorption costing is that it is GAAP compliant and required for reporting to the Internal Revenue Service. So now what happens in absorption costing is as per US GAAP, that is the the standards that are followed by the American companies. Now over there, what it says is that it is GAAP compliant. So as per the US GAAP, they permit the use of absorption costing in their reporting. Now the second thing is accounting for all production costs. So absorption costing takes into account all of the costs of production, not just the direct cost, as is the case with variable costing. So naturally, as I explained, absorption costing, it consists of fixed and variable, not just variable. The next is absorption costing includes a company's fixed cost of operations such as salaries, rents, all of that, and it has a more complete picture of the cost per unit for a product line, can help company management evaluate profitability and determine prices of the products. Now, what this point basically means is that now that you have fixed and variable costs in your under cost of production, again as I mentioned, selling price is equal to cost plus profit. So now that you have all the fixed and variable costs, the entire cost that you've incurred in your cost factor, and now that you know what profit you want to achieve, it helps you better determine the selling price. And that selling price in turn helps you recover not just your variable cost but also contributes to recovering your fixed costs, and at the same time contributes to the profit of your company. Now the next point is tracking profit. So absorption costing also provides a company with a more accurate picture of profitability than variable costing, and particularly if all of its products are not sold during the same accounting period as they manufacture. This is significant if a company ramps up production in advance of an anticipated seasonal increase in sales. So this, in this particular method, as they mention, as I repeat the same point again, you have also, this is significant if a company ramps up production. So now, if you increase your production, that will increase your sales, and that in turn helps you increase your profit. And that gives your company an advantage, because as I mentioned in the previous point, once your sales increase, or rather the higher your sales, the higher will be your ability to recover your variable and your fixed cost entirely, and that increases your profits. Now I'm going slightly off topic, but just to give you a basic idea, you have when you're acquiring assets and stuff, fixed costs, you'll be taking loans and stuff for that, right? Or self financing. But I mean, if you look at a large industry, you're looking at borrowings. So now what happens over there is you're paying an interest on that. Now, if your sales can contribute to covering that fixed cost, that will help you, pay off your interest, pay off your loans, and that increases your profitability. So, that is one of the things that one of the major advantages of absorption costing. Now, disadvantages is you have skewed profit and loss. So, absorption costing can cause a company's profit level to appear better than it actually is during a given accounting period. And why is that? This is because all fixed costs are not deducted from the revenue unless all of the company's manufactured products are sold. So, what happens over here is that your fixed costs are not deducted, in a profit and loss, is not taken under your expenses. It's not deducted, because now that it's considered, now that it's included in your, your cost of production, that until the goods are sold, it is not accounted for, and that has an impact in a profit and loss statement, because if your expenses are low and your revenues are high, your net profit begins to increase, and that gives you the impression that your company is earning a high net profit, which may not necessarily be the case in reality. So now the second is no influence on operational efficiency. So absorption costing fails to provide as good an analysis of cost and volume as variable costing. And if fixed costs are a substantial part of total production cost, it is difficult to determine variations in costs that occur at different production levels. So now let us break this point down. So absorption costing fails to provide as good analysis of cost and volume as variable costing. So see what happens over here is this for variable is your marginal. So marginal costing breaks down your cost into your fixed and variable, and that gives you a better picture to analyze. Where is it that what part of the costing is draining my income, or what is contributing more to my income. So this helps the management plan out and budget the expenditures, and plan their costing very well. And what happens is over here, that helps increase the operational efficiency of the company. Now it is difficult to determine variations in costs that occur at different production levels. So see what happens is, now with both of your fixed and variable together, it becomes very hard to determine the variation in cost, because your entire thing is one. So you will not understand whether your variable costs are going good, or whether your fixed costs are going good. So it's very hard to determine and break that down further once you have brought it together. Now the next thing is, this makes it more difficult for management to make the best decision for operational efficiency, and it also causes a problem for analyzing different product lines. So as I mentioned in marginal costing, when you have broken it down and separated, you can determine you can measure the costing efficiency in your different product lines. But here, when it's together, it's very hard to determine whether product lines are actually doing good because fixed cost is included or not. So you have to break that down to understand it better, which makes it a more tedious task. Now let us talk about the difference between marginal and absorption costing. So first is cost application. So only the variable cost is applied to inventory under marginal, and over here in absorption you have fixed and variable. So that is the first difference. Second is the profitability of each individual sale will appear to be higher under marginal costing, while profitability will appear to be lower under absorption costing. Now let me explain why. So the profitability of each, it is higher under marginal costing. Now why does it say that? Now it says that it's higher because you're not including your fixed costs in your product. So now, for example, if say your costing is 10 rupees, okay, and from that, let's say 6 rupees is your fixed, 4 is your variable. Now in marginal, you're excluding that 6, so your cost is only 4. Now what happens if your cost is 4 and say, for example, profit is 10, okay, that will increase your it will wait, let me explain it properly. So see, say your from 10 rupees, 6 is fixed and 4 is variable, right? Now if you exclude 6, that has brought down your cost to 4, right? So now when you bring down your cost, what happens? Your profit increases at a fixed selling price, that is. So now what happens is, what this says is that over here from marginal costing, you will have a higher profitability, but for absorption you are including that 6 of fixed cost, so your total is 10. Now if your selling price is constant, your cost of production is high, what happens? Your profit starts reducing. So that is what it means. It means that your absorption costing brings down profitability, while as marginal costing takes it higher. Now the next thing is measurement. So the measurement of profits under marginal costing uses the contribution margin, which excludes applied overhead. Now, as we learned, in the first chapter, you saw, right, selling price minus variable cost gives you contribution, right? So now what this means is that obviously the measurement of profits under marginal costing uses the contribution margin. So that is your selling price minus variable cost, and that obviously excludes your fixed costs. But for absorption, we are talking about the gross margin. So what is that? Is basically selling price minus variable cost gives you contribution, minus fixed cost gives you your gross margin. So what absorption costing speaks about is the gross value, whereas marginal costing speaks about the higher value. Now the next is an additional difference is that absorption costing is required by the applicable accounting frameworks for financial reporting purposes. So see, this is a very interesting point. So an additional difference is that absorption costing is required by the applicable accounting frameworks for financial reporting purposes. and so that factory overhead will be included in the inventory asset. And marginal costing is not allowed for financial reporting purposes, so its use is restricted to internal management. So what it means is marginal costing is used mainly for internal reports, whereas your absorption costing is used is it is what the standards suggest, and it is used by companies for financial reporting. Now let us speak about an example. So let us assume that we are manufacturing a product X. So your materials, let's say are 5 per unit, labor is 1 per unit, and fixed cost is 25,000. And let us assume that our planned output is 50,000 units. So now, So now under marginal cost, only variable costs are considered. So the marginal cost will be equal to your labor, that is your labor plus your materials, but a fixed cost is excluded. So that will give you 6. Now when I'm talking about absorption costing, you're talking about fixed and variable costs are considered. So absorption cost is now equal to marginal plus your fixed cost. Now why did I take marginal and not variable? It's because of this. It comes to the same thing. Marginal cost is equal to labor plus materials. So that's why I've considered that. Now over here, you might be asking, how did we get the 0.50 for fixed cost? So now you have 25,000 of fixed cost and 50,000 of units of output. So how do you get your cost per unit? Is simply by taking your fixed cost divided by your units of output, right? So 25,000 divided by 50,000 gives you 0.50. And that 0.50 of fixed cost is then added to your variable cost, and that gives you 6.50. So before I end, let me show you the difference. So you have marginal cost is 6 and your absorption cost is 6.50. So you can see how including your fixed cost has increased your total cost, right? Total cost of production. So yeah, that's it. Thank you. And I will also be attaching a video, a link with this link as well. And so you can in your free time you can have a look at it and better understand this both of these costing terms.